Hello, good morning. Okay, today, Sighting is away at Shan Road, so he's not presenting the macroeconomic update. My name is Jeremy, and I'll be just running through the OCBC, and I've done it in a way to compare it with UOB, since both of them have already announced the results. Okay, so point to note, the net interest income for OCBC is higher than UOB in absolute terms, but if you can see that the NIMs for OCBC is actually lower. That's because they have more assets to actually yield in the interest income. And actually, it's not so much the non-bank non-bank loans, which you can see here. The non-bank customer loans is relatively the same, and actually the OCBC have priced their interest on this non-bank loans lower. But how it has they can actually manage to have a higher net interest income is because of the placements of and loans to banks. And we felt that the North Asia, the Greater China exposure, the Greater China franchise is actually working for them. You can see here the Chinese banks exposure, 17 billion as versus the UOB. And 85% of this 17 billion is to the top five Chinese banks, policy banks. So if we feel that moving forward with that close relationship, it will help them with the net interest income. And as for everything else, the ratios, CET1 leverage ratios, they look healthy and looks better than UOB. And generally, the tone of the earnings results has been towards the exposure of oil and gas, and that's exceptional attention. And we can see here that the O&G exposure is very similar, it's at 12 billion. And the value that they are really looking at the core of it is actually 5 billion. And it's quite similar to UOB as well. The only difference is that OCBC has already taken NPL um, of 800 million as of this quarter, whereas for UOB it has not, and it is left with 2 billion that is of greatest attention to the greatest focus on this 2 billion, and the management will continue to manage this, and they'll guide it forward in 2016. So in our in the mod in the call for this OCBC, we have come up with a model, and in the model we have assumed that oil prices would remain unfavorable for offshore charterers. And so how did we come to this assumption is that we see it as a competition of shale oil and offshore. If, say, OPEC has sorted out the supply, and oil price will move towards 60, and we feel that at that point there will be continued competition between these two forms of production. The reason why shale oil could be a real threat to offshore is because both they lie side by side on the cost curve. So shale oil is you can produce it at about 60, while the offshore is profitable, break even at about 70 to 80. And the problem is when oil moves to 60, moves to 60, shale oil has the ability to come online very quickly because of two aspects. One is that the production is the characteristic of the production is uh, very it's very similar. I mean, as in they are basically using the same equipment, and they could use the same processes to actually drill. So which means is that the investment decision will come in a matter of weeks rather than years, right? And the life cycle for shale oil wells are much shorter than conventional oil, than offshore, which typically is they would have a decline rate of 75% in the first year. So they don't have to commit that much capital equipment on the long term. So when this happens is that with the offshore producers will look at it and say, okay, given that the capital equipments now, they may not be able to commit, they have to commit typically at eight years, but now it's challenged and they will say, should we commit on long term, considering that there's a competition on the from shale oil. So this would probably affect the charter rates in terms of the tenure of the charter rates, and also the volatility of the charter rates, even at oil price at 60. So this will in fact create some headwinds for the offshore players that we have here, who have loan exposure, who have typically taken on loans on the longer term. So the new NPL formation of 800 million is, we assume it to be similar to that of 2014, and that's an assumption that even if oil price were to move out a little bit higher, this would still pose a risk in terms of cash flow for the offshore players. Okay, that's the end of my presentation. Has anybody any questions? Okay, as for the question whether OCBC is able to weather the headwinds, then you will be, yes, we feel that OCBC could better manage their ALM, right, asset liability management, could price their deposits a little bit higher to attract them, attract deposits, and they also could compete on the interest. um, they could be more competitive on interest. So in that sense, we feel that OCBC would be in a better position in terms of succeeding. Okay, there's a question of a can of worms exposure to Greater China. I mean, we could price in doomsday, China collapse, Singapore collapse, everything is dead. But no, we are not pricing in, um, you know, um, a major fall in China. We are not pricing in Singapore properties to collapse and all that. It's just the oil and gas, which is basically guided by the management of the banks. So if there's no other questions, I think we can end here. Thank you very much.